tuned to Buy Now, Sell Now with me, Karunya Rao and Varun Hiremat. Before we proceed with the show, we have a stellar lineup of speakers talking at the CII Financial Market Summit. Let's cut across to that.
It's averaged around 9 to 9.5 lakh crore per year. Though it sounds impressive, the same needs much ramp up considering the needs of a developing economy. The capital markets work on the principle of disintermediation. That is, by directly bringing together the issuers and investors. Clearly, this can work only if all relevant disclosures are readily made available by borrowers to investors so that they could take decisions after analyzing risk and return of the investment. Trust of fair play and faith in the regulatory system is of utmost importance for capital markets to thrive and sustain. This being the defining principle, much of the efforts of the regulator go in ensuring the same. Now, coming to the present scenario, we are indeed going through a very difficult and challenging times. The June quarter saw a 23.9% drop in GDP in India over the same quarter last fiscal. RBI expects a 9.5% drop in GDP in this financial year. It is not just India, but the entire world is going through a recession phase. While different agencies project different numbers for the global GDP forecast for this year, everyone agrees that the global economy will surely contract in a major way. In this backdrop, I would like to briefly touch upon the recent performance of capital markets in India. First, let me take the secondary market movements. Immediately following the declaration of pandemic in the month of March 2020, the markets reacted adversely. The lower circuit breaker was triggered on two occasions within a span of just 2 weeks, an occurrence which has never happened in the past. The volatility index VIX went up to 84 in March from an average of 15 in previous 3 months. SEBI took some timely surveillance measures with respect to exposures and margins to curb volatility. The markets have recovered well since then. The Sensex Nifty today is very close to all-time high hit in January 2020. The volatility has also relatively stabilized with the VIX now hovering around 25. While one repeatedly hears the liquidity and low interest rates are the only prime factors driving the markets and that there is a disconnect between the market and the real economy, I would like to place before you certain positive aspects of the market recovery so far. We have observed that recovery in the market has been rather broad-based. Our analysis reflects this fact on 3 counts. Firstly, it is not just the large cap but also the mid and small cap indices which have recovered since the low hits in March 2020. While the large cap and mid cap indices increased by around 55%, the small cap index has increased by around 70%. Secondly, while statistically the indices could go up because of certain stocks which have relatively higher weights in a particular index, our analysis shows that the recovery is not only in the heavyweight stocks but is across the board in the index. Around 40 to 50% of the constituents of each index category, that is large, mid and small cap, outperformed the respective indices this financial year. Thirdly, the recovery is broad-based outside the indices as well. And by that what I mean is, out of the stocks that have traded on NSE and BSE during this financial year, more than 93% of stocks on NSE and more than 75% of stocks in BSE have yielded positive returns as on 30th September 2020. Let us now examine the participation of investors. On a broader level, the participation in equity market is higher now than ever before. The average daily turnover in cash market in this financial year is around rupees 60,000 crore, which is 54% higher than the figure of rupees 39,000 crore last year. The equity derivative segment has also seen the average daily turnover grow by around 27% as compared to the last year. In fact, the average daily turnover in both the cash market and equity derivatives market hit their all-time high figures in the months of June and September 2020. On specific investor level as well, the participation is quite high. I have already commented on the trend of increasing retail participation in markets in my earlier public addresses. To update to update the position, during April-September 2020, 63 lakh new demat accounts were added as compared to 27.4 lakh accounts during the corresponding period last year. That is an increase by around 130%. On the FPI front, we have received around $11 billion of net FPI investments in equity markets in this financial year till date. Interestingly, while most of the emerging markets, including Brazil, Taiwan, South Korea, Thailand, South Africa, Malaysia, have witnessed FPI outflows in the calendar year 2020, so far India has witnessed net FPI inflows during the same period. On the mutual fund side, after initial outflows in March 2020, especially in the debt schemes, we have subsequently seen on an overall basis net inflows of around rupees 1.47 lakh crore in this financial year till September 2020. Let us now turn to primary markets. On the equity side, despite a late start this financial year on account of COVID shock, that is maybe around middle of May onwards, total funds raised have touched rupees 1.54 lakh crore till September 2020, just short of rupees 1.58 lakh crore raised during the corresponding period last year. I am giving September 30, the end of September figures just to compare with the last year. So it's almost same as last year in equities. And almost all the IPOs, rights issues in this year have been oversubscribed several times. Further, more than 22,000 crore equity issuances are in the pipeline. On the debt side, the funds raised through corporate bonds this financial year till September 2020 are around rupees 3.8 lakh crore, which is in fact 25% higher than the funds raised in the corresponding period last year. Now coming to the reforms undertaken by SEBI. Self-praise is no recommendation, goes the saying. While one should follow that adage, it may not be an exaggeration to say that SEBI's policy measures have somewhat contributed in facilitating rather satisfactory working of both the primary and secondary markets in these gloomy and uncertain times. I need not elaborate on the measures taken by SEBI post-COVID, as the same are in public domain and most of them have already been discussed at length at various forums and by the media. And Shri Uday Kotak also, in fact, stated some of the reform measures, highlighted some of them. While many of them were specific to dealing situations in COVID times, we also undertook several reforms of permanent nature. For instance, with respect to fundraising activities, we undertook reforms in rights issue regulations in line with our continual efforts to enhance the framework since last year. These include relaxation of eligibility criteria for fast-track issuances, rationalization of disclosures, relaxation from minimum subscription requirements, etc. Similarly, while we introduced relaxed pricing norms for preferential allotment for all companies for a specific period to address pandemic situation, we also introduced permanent relaxation for pricing norms for preferential allotment by stressed companies. This relaxation for stressed companies is also accompanied by an exemption from open offer requirement, thereby reducing the funding pressure on the prospective investors in such companies. Thus, we broadly followed a two-pronged approach post-March 2020. Firstly, helping on urgent basis the companies struggling during the pandemic, and secondly, continuing and accelerating our efforts to bring in long-lasting reforms. We are also acutely aware of the possibilities of increase in volatility in markets going forward in these uncertain times, both on account of global as well as local factors. We are and will continue to be vigilant for any rapid movements in the market and with regard to any issues which may have systemic implications. You may well ask whether there is any need for a radical reform in capital markets. While, as I said earlier, the term radical may have different connotations, broadly speaking, we are of the view that the development of corporate bond market is an area which needs deeper structural and regulatory changes. This requires coordination amongst the government and financial sector regulators. I have already expressed my views on the subject in my earlier public addresses and may not repeat here. Also, on its part, SEBI has initiated a number of measures to develop the corporate bond market. Of course, considering that today's conference is on the topic of financial market reforms, we would be eagerly waiting for its recommendations on various issues for initiating further improvements. Now, I'd like to briefly touch upon the role of other stakeholders in reforms. While I talked about the reforms brought in by SEBI, it begs the question as to why the term reforms has almost always been associated with the government or the regulators. We believe that other stakeholders need to play equally important role in reforming the financial markets. I would like to identify three specific stakeholders in this regard. The first is industry bodies. Industry bodies such as CII have a very important role to play in financial market reforms. And when I say industry bodies, I also include associations of intermediaries and funds. The industry bodies can and should endeavor to self-regulate and set standards for themselves. Any sincere effort in this regard would enhance the confidence of other stakeholders in the market. I recall that CII had come out with voluntary guidelines for corporate governance way back in 1998, even before SEBI prescribed clause 49 in the listing agreement. That was a commendable effort. If I understand correctly, those guidelines have also been recently updated. We have amongst us Shri Uday Kotak, who chaired SEBI's expert committee on corporate governance, which gave its recommendations about 3 years back. All of us benefited from the committee's report, and a number of amendments in SEBI's LODR regulations have been brought in as a result of that. With Shri Kotak at the helm of CII, I am sure that the industry would introspect, set higher corporate governance standards for themselves, and contribute economic development, especially in these difficult times. My second category of stakeholders is board of directors. The board of a company is an institution which is relied upon by all the stakeholders, including the company's shareholders, employees, regulators, etc., to steer the company in the right direction. The board has tremendous powers under both the Companies Act and SEBI regulations. The independent directors specially represent the voices of the minority shareholders, and as such are important institution in itself. We have observed an increasing trend in the number of resignations by independent directors in the last 2-3 years. If any such resignation is on account of some governance concern, considering the role of and expectations from independent directors, I urge the resigning directors to come forward and state the same clearly to the public at large. My third category of stakeholders are the shareholders. Shareholders have been provided several rights under the Companies Act and SEBI regulations. More powers have been given to minority shareholders over the years, especially with provisions pertaining to special resolution and majority of minority voting. This is even more relevant in the Indian context, with corporates having concentrated holding structures. Institutional investors have emerged as the significant shareholders in the corporates. We have mandated stewardship code for mutual funds and AIFs. IRDAI and PFRDA have also prescribed the same for the entities regulated by them. The shareholding institutions need to play a more active role in voting in resolutions. They owe it in turn to their unit holders, investors in their fiduciary capacity. With e-voting, voting has never been easier. I therefore urge all the shareholders, both institutional and retail, to exercise their voting rights and participate in the decision making by the company. Apart from these stakeholders, there are others as well who can play an important role in financial market reforms and act as gatekeepers of governance. These includes auditors, rating agencies, trustees, proxy advisors, etc. I would like to impress upon all the stakeholders to work towards making our financial markets more robust. Now, to conclude, a well-functioning, deep and robust financial market is a must for economic development. Reform is a continuous process and is best brought in consultation with all stakeholders. Rather than believing that crisis begets radical reforms, I am of the view that we should continuously endeavor to keep improving our systems so that crisis in fact begets no radical reforms. Thank you. Now, I think there are some questions which CII had asked, and I will address them, try to answer some of them later during the later slot given to me. But I'd like to briefly reply to Mr. Kotak's suggestions for improvement. 4 suggestions which he made. And first of all, Mr. Kotak, I broadly agree with whatever you are saying. So we will proceed and have a policy view in consultation with all stakeholders and to what extent we can achieve delivery-based cash market to encourage that. Absolutely right. We in fact are total agreement with that. Capital adequacy requirement for brokers. This historically, in fact, has not been one of the criteria, and there are institutions, the different all type of brokers which are there in the system, and the capital requirements were seen, if I'm right, more than a decade back. In fact, even if not more than that. So it's a reform which also needs to be done. You are right. Instead of taking actions or drastic actions, that capital adequacy itself should be the first level of consideration. So we will examine this. This promoter reclassification LODR, we have been under discussion in PMAC for a very long time, but this is quite a contentious issue, and I will request industry to also support in this. Some way has to be found on this, but please support on this, because it was given to a subcommittee, and then I don't know whether they gave report to the main PMAC, but it is still stuck there. This open interest limit under the surveillance measures announced in March, that also we should be reviewing, but we are a bit cautious. I said that now volatility VIX has come to around 25, which was say around 14, 15 in December 29 and January 2020. And there is still a lot of uncertainties going forward. You would understand better than me. So we are aware of that, and we'll review it. But to be on the cautionary side, in fact, yesterday only we extended it for 1 month till 26 November for the time being, and we'll see how to proceed with that. So that's all I had to say. Thank you.
Thank you, sir. And thank you for a spontaneous response, and really appreciate your being completely on top of what's happening in the markets. With that, I will now request Chandrajit to take it back in terms of the next steps, including Vishal's vote of thanks. Chandrajit, back to you.
Thanks, Uday. Thanks, and thanks, Chairman, for that very wide-ranging topics that you addressed during your speech. So thank you once again, Vishal. Would you like to give a conclusion?
Yes, thank you, CD. Shri Ajay Tyagi, Chairman SEBI, Uday Kotak, Chairman CII, Nilesh, my partner for financial markets, and Chandrajit. It is very heartening today to see so many delegates joining us over this virtual platform. Despite the situation all of us are going through, it's very, very encouraging. We have over 1,000 delegates today on this virtual platform. We've had a very interesting morning session, and we are very grateful to Chairman SEBI for taking out time from his busy schedule and taking us through his vision for the development of our financial markets. His specific comments on reform being a part of normal as well as challenging times is a very, very interesting thought.
Okay. Well, those were some very interesting excerpts from the CII event, which is currently underway. The VIX has really normalized. Markets are now functioning properly. It's been a broad-based recovery, so not just for your large cap stocks, but for your small cap and mid cap as well. A large part of this is due to the financial market reforms. With that being said, we're on good footing. A lot more demat account openings, 1 lakh crore of net inflows this year. Those are some of the chief highlights from the conversation you just heard. We'll bring you more updates throughout the day. Time for a quick break here and Buy Now, Sell Now. We'll be back shortly.
Welcome back. You're still watching Buy Now, Sell Now on ET Now. Kunal Bothra and Gaurang Shah both are standing by. Let's take it across to them to get in their picks as well. Kunal, hi. First, the technical picks. What are the high risk and low risk bets you'd like to recommend?
So, good morning, Karanya. I would recommend two buy calls, and both of them from the sectors which have been buzzing quite strongly. First one is about Tata Steel. I think it's a very interesting chart. The stock has shown confirmations of breakout on the multi-scale time frame, daily, weekly, as well as on the monthly. So I would suggest the buy on Tata Steel. In fact, yesterday I had done a chart buster presentation on Tata Steel as well, indicating how the long-term trends are reshaping on the positive side for Tata Steel. So again, a buy with a position target of 440, stop loss to be kept at 380. And the second would be a buy on Federal Bank. This is more of a short-term buy. I believe that the stock, after 2 days back, of a strong price up of 7-8% kind of an uptick, has seen a very decent follow-through. Today, it's confirmed a breakout above 200 moving average, which I think is a very strong breakout for Federal Bank. So that's also a buy. Targets of 62 and stop loss scale to 55.
Okay, thanks for that, Kunal. Two good picks coming in there from him, both high risk and low risk, Federal Bank and Tata Steel. Take a look. Gaurang, hi, good morning. What's on your radar today? A high risk and low risk idea for our viewers.
Thanks, Varun, and morning to all of you all. So, fundamentally, I think the risk is very, very low, subject to, of course, you buy into stocks with a little bit of homework and from a long-term point of view. And with that perspective, I have two long-term, low-risk investment ideas. The first one is from the private sector bank. Of course, we are yet to see the numbers for this bank, Axis Bank. But I hope that as HDFC Bank has delivered, ICICI Bank, Kotak Bank and Axis Bank will not disappoint. 660 are the long-term targets on Axis Bank. And the next one is from the sector which has been in the spotlight for pretty long time, and that is information technology, IT. And the stock is Infosys, long-term targets of 1,350.
All right, Gaurang. Thanks for your fundamental picks as well. Let's address some viewer queries then. First up is an email from Atish Chabria of Mumbai. He wants to invest in L&T Infotech at the current market price. Wants to ask whether he should do it right away or should he wait for the stock to further cool off. Kunal, given that it has come down by about 150 odd rupees from its recent highs, do you think it's a good time to add or should he wait?
So I think it's a good proposition that you've selected the stock, but the concern is that the buying price. Now, the stock from, I think 1 week back was at 3,500 levels. Now the stock is at 3,100. So there's already been a 400-point correction. But the question is whether there could be more correction. Now, if when you're looking to buy something from a long term, it's typically not possible to try and buy the stock at a perfect price. So I think the best strategy over here is you have to buy in tranches. So I think you can start buying at current levels. But I, for one, believe that many of these mid-cap IT stocks, which have risen up steep and high in the last few weeks, they could probably see a steep correction or at least time-wise correction. And if traders and investors can take benefit of those kind of corrections and then try and purchase at lower rates, I think it's a much more prudent strategy. So I would suggest the buy on L&T Infotech, but I think starting point should be at current levels of 3,100. But keep some powder dry in case if the stock corrects to say 2,900 or 2,800 range. I think that's a good enough range for you to average further.
Okay, great. Thanks for that, Kunal. So you like the stock, you're just a little wary of the entrance price. Gaurang, coming to you, what should Atish do? It's up 5.5% today, although on the back of a very strong result. So do you think some correction might come and he'll get a better entry point? Or do you view this as a good time, to get into L&T Infotech?
The thing that you can do in the stock market is try time the market. And in trying to do that, Varun, most of the people lose out on the opportunity to get invested in good stocks. And correct me if I'm wrong, I think a month back, L&T Infotech was, 2,300, 2,400 or thereabouts? Correct me if I'm wrong. And from those levels to current level, it went up because of a couple of news triggers. And of course, like you rightly mentioned, very strong earnings. Now, this company comes from a very strong pedigree. It has got very sound, focused business strategy, and along with that, the visibility on earnings front. I have always been an advocate of, you should never be in a hurry to go and invest in the market, but you should always be in a hurry to book your profits. And with that, thumb rule, I think you can start investing at current levels, put at least 25-30%. And if you do get correction, then corrections are always, there are two parts of the market. One is going up, one is going down. And so is for the stock. So you will get opportunities of lower levels to add to the stock at lower levels, but definitely a good investment pick from the IT pack, mid-cap IT, and staggered investment is what I would say.
Great, Gaurang. Thanks for that very clear advice. So he advises getting in now and use corrections to add. He likes L&T Infotech. So Atish, you have a thumbs up from both our experts today. Let's get on board our next query now. And Avisha Dadlani of Mumbai is also writing to us. And she's been looking at metal stocks and she wants to identify 2 or 3 good picks from the metal basket which offer a good long-term horizon. So Kunal, what's on your radar? What are some good metal stocks she could look at?
Stocks which I mentioned, was Tata Steel. It was also one of my, calls, Varun. So I would recommend that. In case if you are not, I think if you wanted to buy, say, some of the other large cap metal stocks, then you can probably look at even JSW Steel. But I would advise that keep a concentration on at max 2 or 3 stocks only from the metal pack, because it's very, very concentrated when you see the plays and when you see the price moves into the metal pack. So in large caps, you generally talk of in the top 2-3 key names, like Tata Steel, JSW Steel, and probably even at Hindalco. And the mid-cap name, the predominant one, a high beta stock, is Jindal Steel. So I think these are the 4 stocks which I think should be on your radar. Tata Steel is what I would recommend, because of the clarity of chart patterns on the longer-term time scale. But I think if you're looking at it from a mid-cap name, and if you assumingly have a high, risk appetite, and you can digest those high volatile moves, then probably even a Jindal Steel could be a good bet. So pick 1 or 2 of the large caps and then probably 1 mid cap, assuming if you have that appetite, to tolerate the high risk on Jindal Steel.
Your top bets within the metal universe.
Well, so Karanya, my first advice to her is that be extremely clear that metals always is vulnerable to international commodity prices and the news flow coming out of China. If you are ready to accept these two, and if you have an elevated risk appetite, then we have at least 4 or 5 picks from the metals pack. But if I have to pick 2, then I would agree with Kunal. It is Tata Steel and JSW Steel.
All right. Thanks for that, Gaurang. So I hope Avisha got those recommendations out loud and clear. You can look at Tata Steel, JSW Steel, couple very good stocks in that basket. On that note, a big thank you to both our guests for joining in as always. Great to get perspective from you. Let's now switch gears a little bit. Earlier on in the morning, we had a mega ET Now exclusive where our managing editor Nikunj Dalmia caught up with Aditya Puri with possibly his last media interaction as the MD and CEO of HDFC Bank, as he's supposed to soon retire. He spoke a lot about the digital push at the bank, the recent balance sheet growth and how credit growth for HDFC Bank is really robust. Also some of the factors that have led to that over the years. Let's listen in to this exclusive interaction.
Mr. Puri, banks are ultimately a proxy to the economy. But if I look at the numbers, what you've reported for the quarter gone by, which came last weekend, HDFC Bank is back. You're firing full cylinders. Your line managers are saying business is back to normal. In fact, in some cases, it is back to almost pre-COVID levels. So how come there is such a disconnect? I know this is a year of disconnect, but for HDFC Bank, the disconnect, I think, is very obvious.
The disconnect, let me tell you where I'm coming from. एक तो ये हिंदी में बोलता हूँ थोड़ा सा, ये जो माहौल लोगों ने बनाया हुआ था मर गया was not warranted. So fundamentally, how is it that the car fellows are doing so well? How is it the two-wheelers did so well? How is it that the rural economy did well? Everybody said वो कुछ नहीं हुआ वहाँ. अरे किसी ने उसका फसल खरीदी होगी, किसी ने वहाँ पैसे खर्चे हैं, किसी ने रोड बनाई है जो डिमांड आ रही है. How come cement is doing well? How come steel is doing well? And then everybody said, अरे बैंक तो मर जाएगा, 70% moratorium, 70% NPA. ऐसे थोड़ा ना चलता है. The fact of the matter is, and I'm telling you again, we have not taken any unnecessary risks. We do believe that India is one of the best opportunities going forward. I think globally they're underestimating the change that will come in semi-urban and rural India. We are probably the best placed based on the digital initiative that the government has put in to really revamp our businesses and become competitive globally and improve our yield as well as put in better infrastructure. So I think I'm not saying everything is okay. Yes, there are portions of the country that are suffering. But I think the negative sentiment was overdone and is even overdone now.
Will I be wrong if I say that in your interpretation, the pessimism was overdone and the economy is simply normalized? Will I be right in communicating that to our viewers as your take on the economy?
As our, not my take, as HDFC Bank's take on the economy, absolutely, and our results show it. And so do the results of the other customers. You know, we also had a situation, how will the government finance the deficit? Deficit, ye hoega, wo hoega, state ka ye ho jayega. Now they've announced another 1 lakh, whatever, 30,000 crores of additional borrowing. What was the movement in the yield? 3 basis points? And I think the governor has rightly looked through and the MPC has rightly looked through inflation because it's supply side and it's basically consequent to lockdown, vegetable and proteins and gold. But if you look through, it will normalize. They've also kept the liquidity. They've allowed HTM, they've got OMO, they've got LTRO. So itna rona kis baat ka bhai?
Mr. Puri, HDFC Bank has managed to gain market share, you managed to acquire customers, but that's because you're in a leadership position. What applies to you, you think that will apply to the rest of the economy as well?
Dekho yaar, Niku, the fact of the matter is demand is there. Even if we are not people who are not in leadership, demand to kuch to hogi, sari demand to humne nahi pakad li, itni to distribution hai nahi hamari. But we did a lot of things right, and I think if they've not done it, they should. We went to semi-urban and rural India where 60% of the country lives. If you see the credit deposit ratio in the country, it's 130%. If you see it in semi-urban and rural India, it's 30%. Lending as a percentage of GDP there is hardly 5 or 7%. It should be at least 40%. You'll create a complete new middle class. We are banking on it. 50% of our distribution is there jointly with the government distribution company called CSE. We will set up over the next 6 to 9 months, 25,000 banking correspondents. And we have total of 3,000 branches there. So, and we will deliver digitally. So demand hai. You focus, identify it, put the hard work to get it.
Mr. Puri, you also identified 2 areas as the growth areas. Something which I heard at the con call from some of your team members: infrastructure, healthcare. Semi-urban and urban you've already spoken about. Now, historically, HDFC Bank has shied away from the infra space. But do you think now things are looking up for the infra space and you would be lending there and you would be lending there quite aggressively?
Nikunj, we never shied away from infrastructure. We shied away from infrastructure we didn't understand. तुम प्लांट लगा रहे हो, गैस सप्लाई नहीं है नहीं तुम्हारे पास, तो मैं कैसे लेंड करूं तुमको? कोल सप्लाई नहीं है तो कैसे लेंड करूं? तुमको AAA yield चाहिए, and you got all these question marks. How do I lend? So now actually in the debt capital markets, we are number 1 in terms of financing. That is a major achievement. I think most people have not realized that we are number 1 in DCW, debt capital market, DCP. We are also very clear, and the government has also changed the way they are structuring infrastructure projects. So in the structure, if you put in the proper risk parameters, you have the owner will pay on time. All approvals are there. You've got a good contractor. Then you can do infrastructure, and that's what we are doing. So we are doing solar, we are doing roads, we are doing wherever he can show us that he's covered the performance risk, he's covered the promoter risk, he's covered the payment risk and the regulatory risk. And the more the government does in terms of structuring projects, I don't think there is any shortage of financing available, provided the project is structured as a viable entity. If you want to subsidize, then provide viability subsidy.
Well, that was the Mega ET Now exclusive. We'll keep getting you excerpts from that very, very important interview all through the day. Slipping into a break here, more updates when we come back. Stay tuned.
Hello and welcome back to Buy Now, Sell Now. It's 11:45, so you know what that means. It's time to address the BNSN quiz question for the day, like we do every day. Today's question to you was, which of the following agrochemical companies has the highest market share in its respective segment? Your options were multinational UPL, MNC Bayer, local MNC Rallis, or Sumitomo Chemical, which is also an MNC. The correct answer today is UPL, which is leading as far as market share is concerned. And we have two winners, Shiv Lal and Ankush Mundra. Thank you so much for tweeting to us and congratulations on your hearty win. Do keep tweeting to us on the ET Now handle and we'll be bringing you more of these questions on a daily basis.
All right, moving away from the quiz and the answer, Times Network's Special Investor Education Initiative, Nivesh Ke Fande, shares important tips on how to manage your financial portfolio and guides you by shedding more light on some important aspects of personal finance planning. On this edition, we're looking at debt funds. Listen in.
Today on Nivesh Ke Fande, I want to talk to you about debt mutual funds.
Yes, Mubina, most people do incorrectly believe that mutual funds invest only in equity markets or shares, as they are popularly called. But that's not true.
You're right. Debt mutual funds invest in government bonds as well as other debt securities.
And while equity mutual funds are considered to be a risky investment, some people also consider debt funds to be risky as well.
Well, actually, nothing in life is without a little risk, right? I mean, not investing your money at all is also a risk, as then your money does not grow at all.
So true. Debt funds do carry some amount of risk, but not all funds carry the same level of risk. All debt funds do carry lesser risk than equity mutual funds, but it all depends on what the debt fund that you pick is investing in.
Well, as they say, risk and return are directly correlated. So it's important to assess your risk appetite when choosing a mutual fund that suits you best.
That's all on this edition of Nivesh Ke Fande. Stay tuned for more insights on investing on the Times Network.
That was our new initiative, Nivesh Ke Fande, where we're bringing you complex investing concepts and helping you to digest them and apply them in your retail investing life. I hope they're making a difference to you. They are very interesting, and there'll be more of these coming out. It's a series we at ET Now are doing. But as part of some of our educational packages that we've been putting out, let's bring you one from Mubina Kapasi talking about the e-commerce boom and how really the whole e-commerce sales have shaped up ever since the pandemic began and how they've grown over the last year or so from pre and post pandemic. Let's listen in.
Websites are opening the doors to discounts and deals as mouth-watering as Diwali's mithais. But a rookie online shopper may lose their way amidst the cacophony of offers and schemes and end up with a cart that's overspilling or a wallet that's wanting. Here are simple mistakes to avoid and ways to navigate the online malls. Amidst all of the uncertainty we're in the midst of due to the pandemic, making a budget has assumed prime importance when you log on to shop. You may also give yourself a budget for items that are not on your shopping list but may catch your eye during the sale. Not making a shopping list when sitting down to surf is almost like letting a kid loose in the candy store, especially if you are prone to spontaneous shopping. A better idea would be to add items to your wish list even before the sale. Last 2 pieces available. This line is for sure to make those with FOMO sweat and press the buy button. It's no surprise that this is one of the most persuasive techniques used by sellers. Well, shoppers snap out of it and seriously consider the cost-benefit analysis of buying the product. It may be tempting to assume that the price during the sale is very attractive, but it may not be the case. Ensure that you scourge other websites or even offline stores for prices before zeroing in. Be it after-sale services or warranty. Ensure you're getting the most of the buck and beware of any additional costs you may have to pay.
So now that we have your back, go online and shop your heart out.
I hope you've taken note of the simple mistakes that you can avoid while navigating online shopping portals. And there's just one day left for the mega festive online sale to end. Grab the best deal at the right value and simultaneously save with the lucrative bank and credit card offers. But how should one go about shopping amid a plethora of options? Should one even consider taking a loan? What are the best cards you must make the purchases on? On the Money Show, we caught up with Anshuman Mishra. He's the founder of Loan Adda to understand all of this and more. Here's an excerpt of that conversation.
The first thing is that you go to these e-commerce sites where there is a lot of discount. So they're even up to 80% discount on, a few items. The second thing is, as you rightly pointed out, is the right card. So what kind of card? So obviously there are 2 kinds of cards in a wallet. One is a debit card and one is a credit card. So the credit card is where 80-90% of these discounts happen. And within that card also, your wallet should have an HDFC card. So because HDFC is by far the market leader in this credit card, and credit cards is by far the market leader for trying to give some discounts. So once you swipe your HDFC card, you get really up to around 10% discount over and above what you get in the Great Indian Festival or Bill Billion in Flipkart. So first, go to the right e-commerce site, which is giving you the highest discount. Second is use your card. Third is that it's always advisable to convert it into something called an easy EMI, because what they do is that actually this is a 0% EMI wherein they're getting some discount over and above the e-commerce discount and the credit card discount, which is given to you a little bit of interest, but that the 0% EMI is maintained by the discounting in the product and little bit of interest. So if you use all these 3, then you add a few more things, like there's a Infinia card of HDFC and there's a Diners Black. So you get 5 times rewards which you can use in your next purchases. So let's say you use 1 lakh worth of things, and as our favorite item which we know, the iPhone 11, in that also, like this year also there is a 7,000 exclusive discount on HDFC card. So I think I will weigh my option to use the e-commerce platforms like these couple of these which are there for the next 4-5 days, and second use a card which is preferably an HDFC card.
Okay. We do get, and there are a lot of, today when I go online and I search, let's say if I have a particular wish list, let's say I want to buy a television for myself. The minute I punch in television, there are all sorts of offers, right from no cost EMI to easy down payment and, what have you, to easy loan, etc., credit card EMI, so on and so forth. In such purchases, especially in these relatively higher ticket purchases like television, maybe fridge, air conditioner, what financing schemes that the website offers you should be wary of?
See, Mumina, what happens in that is once you have money in your pocket to buy a white good, see, as long as it is a mobile phone, which is like, say 10, 20, 30,000, or a fridge, But let's say you are taking a high ticket item like a lakh or a lakh and a half of a product. So it's always advisable to take a unsecured personal loan because the rates in that are much lower. Because what happens in this is that the discount that you get.
All right, on that note, completely out of time here on this edition of Buy Now, Sell Now. Keep it with ET Now. We have Markets at Noon coming up next.